Today, we are traveling back in time to 1954 New York for a lesson from history. Warren Buffett, arguably the greatest investor of all time, has long been a proponent of arbitrage as part of an overall investment strategy. He once noted, "Give a man a fish, and you will feed him for a day. Teach a man to arbitrage, and you will feed him forever." In his earlier years, when running the Buffett partnership funds, Warren often noted that arbitrage helped to boost the fund's returns during periods of high stock prices, when he was uncomfortable purchasing securities for long-term holdings, and it was also one of the few areas where he felt comfortable employing leverage. This was due to the certainty of timing and returns. Today, we are going to look at one of Warren's greatest arbitrage investments, the Rockwood & Co. cocoa bean arbitrage of 1954, which was one of the more unusual arbitrage opportunities in history. And Warren being Warren, he found a different way to invest in the deal which reaped a far greater return than any other investor saw. Warren started working for his mentor Ben Graham in 1954 in New York, and he spent his days studying the Moody's manuals, companies' annual reports, and the financial journals, an absolute joy for someone with Warren's analytical bent. During the early days of Warren's time with Ben Graham, they were visited by the owners of Rockwood & Co., a manufacturer of chocolate and chocolate products. The price of cocoa had recently jumped from 5 cents to a high of 64 cents per pound. Rockwood had never been the most profitable company, and this huge increase in their core material put a significant strain on the business because of their limited ability to increase the price of their chocolate products. Rockwood began running at a significant loss, and the owners wanted out. Ben Graham was interested in buying the company, but wouldn't pay the asking price sought by the owners. These were the halcyon days of cigar butt investing, where the Graham-Newman partnership was still able to pick up bargains after the economic bust following the World War. Ben Graham had, however, spotted the opportunity with Rockwood. The company owned more than 25 million pounds of cocoa beans, and if they moved fast, they could sell part of this inventory for a huge profit. Not only could Rockwood continue to make its products, but it seemed highly probable that cocoa prices would quickly normalize, especially if Rockwood suddenly dropped its huge inventory on the market. The difficulty was the tax code. Should Rockwood have liquidated its inventory, it would have been liable for a 50% tax charge, wiping out a majority of the gain on the transaction. This huge tax charge, coupled with the unknown duration that prices would remain at such a high, gave Graham cold feet, and he was only willing to bid a low price for the company. Enter stage left Jay Pritzker. Jay was an upcoming but brilliant investor who, at only 32 years of age, found an ingenious solution to the problem. Jay's deep knowledge of the U.S. tax code identified that if a company reduced the extent of its operations, then no tax would be liable on such a partial liquidation. Jay acted quickly. He bought control of the company and determined to continue making chocolate chips, but terminate a line in cocoa butter. He allocated £13 million, or almost 6 tons of cocoa beans, to the cocoa butter business, and promptly set about liquidating these holdings. However, a man described by Warren Buffett as a brilliant investor didn't simply sell the beans for cash. Jay found another method of liquidating the stock that would reap him an even bigger reward. Jay determined to offer the smaller shareholders of Rockwood an arbitrage deal in the form of a tender offer. Jay offered these shareholders $36 worth of cocoa beans for each share of Rockwood that was trading for just $34, an immediate return of almost 6%. This was good news for the smaller Rockwood shareholders because it allowed them to trade out of the marginally profitable company at a good return, and it was especially good for Jay because, as these shareholders swapped their shares for cocoa certificates, it reduced the total number of shares outstanding, thereby cementing Jay's ownership of the company without him having to buy any more shares. We'll come to explain why this was such a smart move of Jay's in a moment. The mechanics of the trade were perfectly simple. For every share in Rockwood tendered to the share registrar, they would receive a warehouse certificate for $36 of cocoa beans. This warehouse certificate could then be sold for cold hard cash. And to hedge their bets against the price of cocoa falling before they had a chance to sell, it was even possible to sell the cocoa certificate on the futures market, thereby guaranteeing the price and locking in the $2 profit per Rockwood share. This was where the Graham-Newman partnership and Warren Buffett re-entered the picture. Ben Graham was immediately attracted to this arbitrage, buying shares in Rockwood and immediately selling cocoa beans futures to lock in a risk-free rate of return, and he tasked his blue-eyed boy to execute the trade. This was in the days before the internet, or computers, or even the fax machine, and so some footwork was required. For the next fortnight, Warren spent his days purchasing shares in Rockwood, selling an equivalent number of cocoa futures contracts, and then taking the subway to Brooklyn, where he could tender the Rockwood shares at Schroeder's Trust for the warehouse certificates. These certificates were then delivered to the futures contracts counterparty, and thus a risk-free rate of return was locked in. The Graham-Newman partnership profited handsomely from this trade, making a return of almost 6% on capital deployed, and given the short holding period, this equated to an annual return in excess of 100%. However, as we mentioned at the start of this video, Warren himself did something different than his mentor, and he ended up making a lot more money for his efforts. Being hyper-analytical by nature, Warren had spotted something that no one else, other than Jay Pritzker, seemed to notice, or at least that no one else bothered to think about. When Warren sat doing his calculations, he realized Rockwood & Co. held far more cocoa beans than anyone was accounting for. The total amount of cocoa beans, including those retained for the chocolate chips and those being liquidated for the cocoa butter, totaled approximately £80 for every share of the company. However, with the tender offer priced at $36 in cocoa beans, the liquidating shareholders were only receiving the equivalent of £56 of beans. This meant that the remaining shareholders of Rockwood would retain ownership of the company, the £80 of cocoa beans per share, plus an additional £24 of beans per share that were being left on the table by the liquidating shareholders. To Warren, it made little sense to arbitrage the deal when more value was being left on the table for remaining shareholders. He therefore decided to buy 222 shares in Rockwood, totaling approximately $5,400 or $63,000 in 2024 money, which was a significant amount of money at the time for a 24-year-old Warren, and then he simply held onto the shares. This was a riskier proposition than that taken by Ben Graham, who simply locked in a quick 6% return, because Warren was taking the risk that the price of cocoa beans could fall back to 5 cents, thereby eliminating his profit and potentially resulting in a loss. This was one of the first breaks between the Graham method of investing and what became the Buffett approach. Warren, it appeared, was willing to take more risk than his mentor. The reality for Warren was that he didn't perceive it that way. In fact, Warren considered he was taking less risk. He considered that the liquidating shareholders were only getting cocoa beans to the value of $36 per share, whereas the remaining shareholders not only got more cocoa beans per share, it also bought the plant, machinery, and the future earning power of the chocolate chip company. This was a no-brainer for Warren, especially considering that Jay Pritzker would be the one left running the business, and Warren had developed a lot of respect for the financier from Chicago. It is probably of no surprise that Warren was proven right. The shares of Rockwood, which were trading at just $15 before the Pritzker offer and jumped to $34 after the tender offer was announced, continued to rise when the liquidation was complete. In fact, they hit a high of $85. This means that Warren's 222 shares were suddenly worth $18,870, a profit of $13,500, or a profit of $158,000 in 2024 money. Instead of taking the quick 5.8% return, Warren stuck it out for the few extra weeks and managed a return of 250%. It was this method of thinking about investing and seeing that which others missed that compounded into Warren's current $150 billion fortune. For those unfamiliar, you may be asking who was Jay Pritzker, the Chicagoan financier, who was central to this opportunity, and with whom Warren had become so enthralled. Jay Pritzker was born on the 26th of August 1922 in Chicago into a wealthy and entrepreneurial family. His father, Abram Nicholas Pritzker, was a successful businessman who expanded the family's real estate and business holdings. His mother, Fanny Doppelt-Pritzker, instilled a strong sense of education and philanthropy in her children. Pritzker grew up in a privileged environment, but was known for his work ethic and ambition. He attended the University of Chicago, where he earned his bachelor's degree in philosophy and history. Afterward, he pursued a law degree from Northwestern University, graduating in 1947. During his time at Northwestern, Jay was exposed to the workings of finance, which later became central to his career. He briefly served in the U.S. Navy during World War II, which further developed his leadership abilities. Jay, alongside his younger brothers Robert and Donald, took over the family's business interests in the late 1940s. They transformed the Pritzker family's business holdings into a diversified empire, one of the largest privately held conglomerates in the U.S. At the time Jay and his brothers assumed control, the family business encompassed the family's law practice and some real estate. Jay's father Abram began buying and managing properties in Chicago in the early 1900s, focusing on undervalued real estate and commercial buildings. He was involved in the ownership and management of apartment buildings, and this formed the backbone of the family's early wealth. Abram Pritzker, now supported by his sons, pursued a strategy of acquiring smaller, undervalued businesses in the manufacturing and service sectors. This involved a more diversified approach, setting the stage for later ventures, but it was on a much smaller scale compared to the massive acquisitions seen during Jay's tenure. Jay expanded these foundational interests dramatically, especially through innovations in hospitality, finance, and industrial acquisitions, turning the family into one of America's wealthiest dynasties. In 1957, Jay made a pivotal investment that would change the family's fortunes. He bought a small Los Angeles motel called the Hyatt House, near the Los Angeles International Airport. Jay had a vision to create a chain of premium hotels catering to business travelers and upscale tourists. This was a novel concept at the time, as the hotel industry was largely fragmented. Over the next few decades, the Hyatt Hotels Corporation expanded globally under Jay's leadership, becoming synonymous with luxury, innovation, and service. By 1968, the company had built its flagship property, the Hyatt Regency Atlanta, featuring an innovative open-atrium design, which became the signature architectural feature of Hyatt hotels. Jay also became known for his innovative financial strategies, including leveraged buyouts, and he expanded the family's holdings into a range of industries, including manufacturing, transportation, and real estate. The Marmon Group, a conglomerate he co-founded, controlled over 60 companies involved in industrial and financial sectors. Under Jay's leadership, the Pritzker family utilized trust structures to manage their wealth and avoid public scrutiny, making them one of the wealthiest and most powerful families in America. At their peak, the Pritzkers' business empire was estimated to be worth over $15 billion. The Pritzker family, under Jay's leadership, maintained a united front for many years. However, after Jay's death in 1999, disputes arose among family members over the division of assets. This eventually led to the breakup of the family fortune in the 2000s, with the assets being divided among the 11 cousins in the family. One of Jay's sons, Tom Pritzker, took over leadership of the Hyatt empire, while other family members pursued their own. So there you have it, one of the most unusual arbitrage opportunities in history, and how Warren Buffett saw things that others missed, including his own mentor, and made a fortune without taking any unusual risk. If you've stuck with me this long, then a big thank you. I hope you found the video interesting, and I hope you'll join me for more of the same next time. Thank you.